fine with our YouTube. So yeah, hi everyone, and welcome to our next workshop. And this workshop is brought to you by TonNest. This is a program where we support early stage builders, and some of you are here on Zoom with us. Those are the projects participating in the TonNest program or registered through our Luma page, and the rest of the audience are watching this as a live session on our YouTube channel, on Ton Foundation's main YouTube channel. And I'm happy to introduce you to our today's expert and guest, Daniil Shcherbakov. I believe some of you probably remember Daniil. We already had an amazing presentation around 6 or 7 months ago in 2024. And yeah, we are always happy to talk about fundraising. Hi, Daniil.
Hi, Alec. Thank you so much for having me today here. I'm also very excited to actually revisit one of the most, I believe, important topic, which is often overlooked in the crypto community because everyone is so fascinated with the possibilities of Ton, for instance, like, and all of the tech around it. But at the very same time, money drives growth. And if you would like to make your product really something meaningful for ecosystem, you need money. And money, surprisingly, comes not because of the uniqueness of the technology, but primarily because of you as a founder. Because at the early stage, people invest really and VCs in people, not in the projects. But we will discuss it a bit more in a minute. So yeah, thank you so much for having me.
Amazing teaser. And yeah, as the slide on the screen says, Daniil Shcherbakov is a co-founder of TonTon Games and also a startup mentor and startup advisor, lecturer. And yeah, we decided to break this topic down into two separate parts. This time we probably will talk about things about misconceptions, fundraising misconceptions, and we also will cover next week another session with the topic of investor outage or something like that. Yeah, please confirm, Daniel, if I got that correctly. And
Spot
yeah,
on.
I think we can just without further ado, we can start. It's been something around 5 minutes since we went live. And yeah, if there will be any questions in the live chats on YouTube, here on Zoom, I'll be helping you out with facilitating those. And yeah, if you have anything to ask, those of you who are on Zoom, you can just raise your hands, send your questions in the chat, and unmute yourself or and ask any question with your voice. And also, if you who are on our YouTube channel, please leave your questions in the live chat, and I'll be reading the questions myself. Okay, then I think we are now set up. So the stage is
Perfect.
yours.
Let's rock. If I might use this analogy. So once again, Alec, thanks for having me. And I believe, guys, the first question should be, who the hell am I? That it is not my first, but already second time of being a presenter or in the Ton Nest, and why actually Alec invited me all over again. So I have been doing tech startups for, gosh, over 12 years now, with a ton of sparkling failures, a few moderate successes, and my latest venture is actually TonTon Games, which we co-founded together with my partner last summer. To date, we raised over $1 million from reputable angels and VCs, crypto VCs primarily. In total, I raised for different ventures over $5 million, and I actually quite frequently mentor and lecture across Europe, United Kingdom, in States. And this is why, for instance, I'm here today, because I just love sharing knowledge. It keeps my knowledge up to date, and to be very honest with you, brings me a ton of joy. And I also happen to hold an MBA degree from the University of Cambridge. So yeah, if any one of you is actually thinking of a proper business education, you can always reach out to me with exactly that question. And today our session is to some extent unconventional, in a way that what I really would like to talk today about is not what to do. My actually experience taught me that luck, whether luck is closed round or anything else, is a product of amount of attempts. And what's more, there is no right way to launch a successful tech startup or a crypto startup on Ton or a game on Ton, because it's always unique. Like this is why, there is only one not coin, for instance, and Hamster Combat last year wasn't really able to repeat the success, as we all know. But at the very same time, even from this specific example, mistakes that are done on the way are pretty much the same. So today's masterclass would be primarily about those, with some cherry on the top at the end, but I'll tell you more about it later. So without further ado, let's dive deep. So, first of all, I think I would like to put a mindset into you, a very important one, that you should think of fundraising, because for some people, fundraising looks and sounds more like snake oil, in a way that should be always a silver bullet, some secret so you would be able to close around. But actually, it is not that different from sales, but in that kind of sales, product is you, the entrepreneur, not a specific feature or something. So yes, this is why, and in other words, I believe fundraising is also akin to looking for a job, when a pitch deck is essentially your CV. But if you think from that angle, you never been hired just based on the CV. CV opens the door, and then you, as a candidate, basically lead the conversation with the recruiter and hiring manager. So, what we're gonna talk today about, as I mentioned, the common misconceptions about fundraising. The right tone of those actually today, I came very prepared. And also, as I mentioned, the small cherry on the top for those of you who won't be able to join us next week, where we're going to go really deep into how structure cold emails for the investors outreach. But finally, let's get started. First of all, I think this would be on the Mount Rushmore of the most common misconception is the fact that we will raise within a month. I think, guys, what you should understand that the average fundraising cycle, whether you are in crypto or in a more traditional tech space, is within 6 to 9 months. Moreover, from personal experience, I could say that, for instance, doing an ICO or token generation event is also not the best strategy for quite a few reasons. But to start with, that once you launch your coin, everyone, at least the most of the audience, would be far more curious and concerned about your coin price other than the performance of your project. So for some people, it might think that it is an easier way to launch your coin, but in fact, it is much harder way and requires much more delicate approach to fundraising, because here is community involved. Think even from the like stakeholder management standpoint. If you raise from, let's say, a dozen of investors, which is actually a huge round, most likely it should be like 5 to 7 people, not 12. It is easy to manage then thousands, if not tens or hundreds of thousands of people that chipped in for $5 and sometimes require the same or if not more attention than the people who invested 20, 30, 50, 100K. So think from that perspective. And second of all, you won't raise within a month. You might say to me, Daniel, what the hell are you talking about? I know project X, Y, Z that actually were able to fundraise within a month, but these are more often outliers. And when you dig a bit deeper into the biography of the founders or something like that, you will find something exceptional. Like, they did this for the last decade, already have 2 failed projects, more or less in the same field. And this is their third one or something like that. So once again, not within a month. Get ready for a bumpy ride, especially in the current cycle, and the average fundraising time frame within 6 to 9 months. Great ideas raise money. Of course, it's not as much as great protocols, layer 2 solutions raise money, or whatever else. Nope, guys, for better or for worse, it is not the ideas that raise money. As I already mentioned, it is you and the opportunity of your project to generate money for the investors. There is a good old saying that more or less means that in order to earn money, make sure that your investor earns money first. So you are launching a project, and I think a lot of the people, especially when they're daydreaming, they think that this is all about the technology. But for the real VCs or angels for whom it is a business at the end of the day, they really look at your venture from the standpoint, let's say, what is the likelihood of you getting 100x? Also, I need to mention that, of course, there are non-qualified investors that might be really passionate about your idea and so on and so forth. But here is a problem with those kind of investors. They might give you money, and that kind of money might not be a deal breaker for them, but they might be unaware of the risk of investing into a crypto startup. And when you will lose their money, specifically from people who are not in the game, you might have a lot of problems in a way that angels and VCs, the loss of at least half of their ventures investments already factored into their business model. While for the individuals who are more like, as they call, friends, family, and full cohort, it might be a huge problem. So always think about how to manage that. And I nowadays don't often suggest to raise money from people whom you personally know and without any explanation of the risks. So really think of that perspective. And finally, last but not least, remember that it is you who is the cornerstone of the pitch. Why it is so? It's actually kind of complicated question, but I will try to answer it in short. But in a tech world, a lot of the startups, they pivot. Whether you do crypto, whether you do traditional startups, it's not very much the same, to be very honest with you. And the key thing is that the idea that you start with might change a few times up until you find your proper product market fit. You might start as a layer 2 solution, then end up doing like very different on a different chain, and so on and so forth. And investors are well aware of that. And for them, it is much more important to understand your maturity as an entrepreneur. How do you behave under stress? What they should expect from you in that kind of circumstances, because they will definitely come, whether you are aware it or whether you anticipate them or not. And this is what they look for. Understand how you're going to handle those crises. And from that, there is another interesting outcome. Investors are far more likely to invest into entrepreneurs they invested before but lost their money than into new investors with which they never worked before. Why so? Primarily because of the previous things that I mentioned, because they know how failed entrepreneurs behaved under scrutiny, pressure, and the reality of having to shut down the business. So think about from that perspective, when you're creating your pitch, don't dedicate more than 2 or 3 slides about your technology. Draw a picture of why you and your team stand out as an entrepreneur and individuals. Another common misconception: VCs are the goal. As I already mentioned, there are angels, there are also non-professional investors, and what's more important, in addition to all of that, there are another often overlooked type of the angels. So non-professional angels, but the people who are in the field. So for instance, instead of trying to pursue angels or huge venture capital funds, why don't you reach out to the executives of chain that you would like to build on? TonTon, for instance, or any kind of people with a proper network to invest. And they not necessarily have to invest a huge checks, but at the very same time, they might invest the network, which is as important sometimes, if not more than just money itself. So just guys, be realistic on why do you need VCs and what they can bring. When I do review investment opportunities as a founder, for me, it is quite often important to reach out to the past companies that this specific investor invested into and ask whether the money that the investor is selling to me is smart, really that smart. It's not good or bad, but once again, look at this from a sales cycle or even job search. You always reach out to the people that already within the company to understand the working culture and so on and so forth. And this is more or less the same. Accelerators are golden tickets. Once again, another common misconception. You know, the way I see it is, especially for the first-time founders, and there is a very great quote about first-time founders by the founder of the Twitch, the streaming platform, that first-time founders always think about how to create unique, one-of-a-kind product, protocol, a layer, NFT collection, you name it. While second-time founders always think about how to create unique, one-of-a-kind distribution channel. And the same applies to the accelerators. I have seen that for a lot of the projects, accelerators, whether it is Speedrun by Andreessen Horowitz, which is recently launched and quite heavily focused on crypto, or any kind of niche accelerators in crypto, are some sort of an end goal. So startups think that once I'll get inside, the rest is history. I don't have to do anything. While accelerators, in a nutshell, are a tool. So when thinking whether you need to spend time on preparing the application, getting into, just sit down and try to understand what the accelerator might bring you and what are the alternatives. So be rational, be specific, don't be fascinated by the big brand names and stuff. At the end of the day, it's your project. And to prove my point, I believe in Y Combinator, the most successful startup accelerator in the world. Since 2004, they have in around 30 or 25 unicorns, so essentially startups that are valued more than $1 billion. At the very same time, from 2004, and they are the most successful, so there is no accelerator that got more unicorns than Y Combinator. So at the same time, from 2004, I believe over 1,000 of unicorns emerge in the Silicon Valley. So the whole idea behind that, you don't have to be an accelerator to build a successful company, just approach this strategically. Then we should talk to investors when we are ready. Another common misconception. Here is the deal. As I mentioned, fundraising is a full-time job, for better or for worse. And the earlier you start talking to investors, the better it would be. Why so? Because investors do not evaluate or judge startups based on the snapshot in time. So like based on the first time that reach out to them and showcase them your metrics, traction, and so on. In fact, for them, it is much more important to see your development over time. So for instance, reach out to a potential investor that is perhaps would be happy to invest in your mind, into your project later on, quite early, is a winning strategy. Because you will stay in touch, you will send this person an update on your quarterly progress, and this is how you build trust. And based on my previous point, saying that trust is a key thing in the entrepreneurship, is like, I can't even overemphasize it. And what's more, don't forget that this is how they judge that you are a mature entrepreneur, because you see entrepreneurship not as a set of random actions or your internal gut feeling. It is more of a chess play when you do strategic moves that perhaps you won't get results right away, but you would be able to ripe them later. Guys, I believe we have around 15 misconceptions, so I'm happy to make a small pause, and if you have any questions, just drop them in the chat. I will do like, a 10-second pause and drink glass of water.
Sure. So yeah, guys, if there are any questions, any comments, please make sure to send them in the live chats here on Zoom or on YouTube.
By the way, here is a great insights. If you guys have to do a customer interview just to validate the need into your project, when you asking an open-ended question and you get a very short answer, just remain silent. That's a funny bit. So the whole idea behind it that the person will get uncomfortable and they will have to continue responding to your initial question. But as far as I can see, no questions so far, which is absolutely fine. Let's go further on. Another important misconception. The higher the valuation, the better. Guys, you don't want to be in down rounds. You don't want to know what is that. It's harsh, it's brutal, so it's better to be realistic. Especially in the downtimes like we do have right now, in general, the economy, I'm not talking about any specific protocol or chain, but in general, it's better to raise under a more pessimistic valuation than more optimistic, because from that point, it would be much easier to raise a follow-on round and not end up being highly discounted. So another point, as I already mentioned, trust is important, and the relationship development is, I believe, as important as trust. So, if you got a rejection from the investor, act like a mature person. Take it, ask for feedback in order to improve and to understand why did they pass, and keep them in the loop. I was able to close a few $100,000 just out of rejections because I kept the investors in the loop, updated them on our progress. They saw it. They saw that we actually listened to their feedback. They saw that we actually changed something or didn't change, and explained them why, because, for instance, their suggestion didn't work. They respected. And trust me, this all, I'm well aware, sounds like an obvious truth, but you would be incredibly surprised when you will realize how few startups really do that. Most of them just like small kids feeling offended, stop connecting to investor, cross it out of the CRM, from their heart, from their mind, or even start cheating on the startup gatherings on the specific investor. Don't do it. Don't forget, please, that our investors are not gods. They are humans as well. And in general, whether you're in crypto, even in real business, or working in a corporate structure, business is run by people. And people relationship is the most precious thing that you need to nurture. The deck will do the talking. Once again, I think I already used the analogy with the CV, so deck won't do the talking. In fact, in my experience, the deck is just a conversation starter, and it is virtually impossible to put all of the things that are required into one deck. And you would be judged not by the deck itself. By the deck, you might end up with a conversation initiation, but you would be judged by answering on to the follow-on questions. This is what that would be the most important for the investor, to understand how do you react on those and how deep is your understanding about your business. So don't spend huge amounts of time on polishing the deck. Of course, it should be logical, but it shouldn't be flawless, sorry. And this is some sort of a living document that you update once you will get feedback from the investors. We need the finished product to raise the money. And I believe we already touched slightly the point that we, if we don't have a product, we shouldn't. But once again, there is not a surprise that I repeating it with the different words, because this is often overlooked. The way I look into it, that we founders, and I'm as a fellow founder can confirm that, love to baby our product. and love to create the product not based on the market needs, but based on our understanding of the things that are missing onto the market. And this is a dangerous path, because by believing our product, we essentially, it's like looking for the keys under the light in the night, not because uh, it increases the chance of finding the keys, but because searching in the darkness is much harder than under the light. So why I'm using this strange parallel? The earlier you start to raise money, the earlier you will start getting feedback from the people that are barely interested, if not interested at all, into your product and to its success. And this will be some sort of a moment of truth for your project. And some might say that they don't want all of this negativity, this is toxic or something, but people who are truly mature will realize that the earlier this some sort of a judgment call happen, the more likely you will still have time, money, passion, energy to do a pivot that would resonate with the investors, with the end users, which is even more important, much more. Another thing, don't think that you raised up until the money landed into your bank account. In fact, signed term sheets are not legally binding still. Up until you receive money into your bank account, don't think that you raised. I have seen people saying that, let's say, we are talking with a fund XYZ, and they are basically signed term sheets, we are going to fundraise, and then something happened onto the market and everything went bust. Like remember when unfortunately Pavel Durov was arrested last year in France, and this was some sort of that kind of event when a ton of the investors become much more skeptical, with no reason actually, in Ton. And I know quite a few projects that, despite their signed term sheet, ended up without money. So and the worst thing, they already started spending the money that they haven't received yet, like hiring people because they thought that the money would come earlier than they have to pay for the team. So guys, this is the worst scenario, and I don't want and suggest you to be in that thing. Get a lead investor first and the rest will follow. I think this is also quite an important of a misconception. Uh, there is no right or wrong answer here. Yes, when you have a lead investor, it is way easier to find rest investors. But at the very same time, if you already have a few angels, one small tier VC that is interested into investing into your project, it is also easier to find a lead than finding a lead without having any kind of investors. It's like a domino effect, and there is no right or wrong thing how to approach it. But my main point, just start building the list of investors that are interested in investing into you. Don't worry about the lead. Don't worry about how many investors you do have. And I even saw a situation when a general investor decided to become a lead based on the traction of the startup while it was fundraising. So yeah, a lot of the things might happen. Just don't get stuck into a specific mindset. There is a great phrase about the CEO of a startup, that the job of a CEO and the co-founder or founder is to do not what you are best at, but what is actually needed at the specific moment. And this is, guys, is not easy, because each of us is naturally inclined towards something that we are most professional at. And this is how our brain works, that we get love to do something that is predictable. But risk, I believe, is the main contributing factor into a success. So basically, risking it all, getting out of your comfort zone, increases the chances of things being off. Another thing, as a person who spent much more than needed money on media, both in crypto and outside of crypto, conferences and stuff, I could say to you that if you are not some sort of a celebrity status person, media doesn't bring you any kind of investors at all. And here is a funny bit that I found out by competing and winning quite a few pitch competition globally. In fact, the startup that investors are interested the most quite rarely end up as a winner. You might ask why. Primarily because by not winning a startup competition, startup is more likely to accept the less favorable investment terms from a specific investor than if it would win the pitch competition. So always have that in mind and don't spend on media. I'm not saying, by the way, that PR is useless. Don't get me wrong. But this is something that would develop like over time, over actually a long period of time. It's like SEO optimization. Don't expect a result after half a month, if not a year, from starting to invest money into that. And look at this from that standpoint. Any capital is good capital. I already mentioned how it is important to work with to work with the stakeholders and to manage what do they expect from this specific venture. I'm not saying anything about like questionable capital of some sorts. At the end of the day, you are the founder and you make the final call. But understanding of what that kind of money might bring to you, what kind of scrutiny or challenges if things go wrong, it will give you a better understanding whether this capital for you or not. I already mentioned this quite briefly, but as you are building and talking to the investors, start talking also to the investors that might become your investor in the later round. Build credibility, send them updates. And once again, it's not a coincidence that I keep repeating that. You would be impressed that most of the startups today on our call would still ignore this because it's uncomfortable, it's lame, it's cringy, and so on and so forth. But at least in my experience, those are the tactics that worked, that brought me investment money, and also, and even more important, helped me to build great relationships with investors that keep supporting projects that I'm personally involved in. Finally, I believe this is our last misconception. I believe that there is already at least one question about this. So fundraising ends when the money is received, or whether the token is launched and you get the money that you needed, or anything related to crypto. In fact, it is not. Working with the existing investors, keep them up to date, is great because it will pay you off in dark times. Because if you raise money and then remain silent, not sending any kind of quarterly updates and so on and so forth, well, when you will have a bad time, you won't be treated equally in a way that it's much better to keep everyone up to date with what's going on than suddenly appear on their porch asking for a bridge round. So please think about that. And also, when you raise your first round, in fact, you will have to continue fundraising. It's some sort of a background job that always needs to be developed by the founder talking to the future investors, because on average when you raise money it should last you for about 12 to 18 months before another round. And if we factor in that on average you will fundraise within 6 to 9 months, it means that you fundraised, work for half a year, and then start fundraising again, and then the cycle repeats itself. So there is a question from Dishant. My request to the speaker is to throw some light on raising through pre-sales, private token of sales. I think my question and my response to that, as I already mentioned, I'm not a huge fan of, first of all, ICOs and token generation events personally. So, for instance, being a game developer and game publisher, none of our games launch tokens so far, primarily because we find it very risky, and it is some sort of a red flag for some investors that you, and for the audience as well, that you are trying to scam them and you don't want to have it. It's bad. Selling token in terms of token warrant agreements. So, for instance, our investments that we were talking about, and a lot of the investors onto the market, they invest into the startup under the safe agreement. And also with that safe agreement, they also sign a token warrant agreement, where, let's say, if and once the token would be launched, the investor will get the relatable share onto the token pool, or token allocation for the investors, or from the full pool. It all depends. I believe for the early rounds, it is more preferable from the all pool than to a specific investor's pool of tokens. And yeah, that's it. But still, you should understand that getting money from the communities, I couldn't say it's dangerous, don't get me wrong. It's just much more headache. Art is asking a question. Thanks for the old misconception. Thank you so much. My pleasure. You have explained a lot about way to speak with the invest partner. Can you tell 3 best way to find, get contacts on Ton who you can pitch for raise? If you're talking games, I believe Inal Kardan is the right person to speak with. He has a great channel on Telegram that I personally read, and there are a lot of insights on the games. Also, check in general the Ton.org website and see who invests. There are a few funds, even just like, guys, Google. This is, I believe, the thing that I'm personally very thankful for my career, not just in crypto, but overall. And say, let's say, crypto funds in Ton, and you will end up with a list. Or go to Crunchbase and look, let's say, who invested either as an individual or as a fund or as an investor into different things. Also, don't forget about the top, the open platform as an investment. Also, there is a Ton Ventures. So quite a few things in the ecosystem and the environment around Ton. I think then, Alec, thank you so much for sharing this. Another question, Daniel, can you elaborate how we should go about fundraising on Ton? I think Alec already sent you a few things. Then Bogdan is asking, what would you do to raise for a DeFi protocol in current market? Any specific things to highlight, maybe? I believe for the decentralized finance stuff, it's finance. And what do I mean by that? For all of that kind of things, it's about the money. So it's not some sort of a game that will have a chance to become a big hit and everyone would be incredibly successful, rich and blah, blah, blah. Think about the money. Explain to your investors how you're going to earn money with this DeFi thing. It's much more important because you most likely talk to the financiers, and financiers are that kind of people who think in numbers. Once again, it shouldn't be necessarily all about that we're going to be break even right away. Of course not. But at the very same time, a clear explanation what needs to happen for your DeFi protocol to become successful, what kind of unique value proposition you do have in order to make this happen is very important. So once again, crypto, non-crypto, it is all still done by the people. And the better you manage the relationships with people, and better you understand what do they expect from you based on their background, academic background, professional background. So I always do the research on each investor that I speak with to adjust my pitch, verbal one, not the presentation, and so on. And this is actually what we are going to discuss right now. So what you should understand in terms of the investor psychology. Angels, they typically invest out of passion. So they are less concerned about the returns because for them it's like a passion project. They earn some money on the bull market and they are happy to distribute it and like basically to make bets to some extent. At the very same time, VCs, they need to see the potential of 100x return on their investment because this is how VC's business model breaks even. And what you shouldn't really forget when talking to VCs that this is business. This is not charity. And it is extremely important, as I already mentioned, have a mindset of, okay, how can I earn money for my investor? Some might say that this is bullshit. We need to create something amazing, be like, I don't know, Musk or Steve Jobs. But for that amount of Steve Jobs and Musks of this world, there are a gazillion of failed entrepreneurs who try to sell the vision. Especially in the downturns, the business model that is stable, break even, or even better profitable is the way to go, especially in the long run. Then, what you should also understand, this all is like coming out of my personal experience, but there always would be outliers into this, like investors that pass on investment because they didn't believe in the founder and the founder broke through, or investors back unknown founder because the niche was hot. Like, remember last year where everyone was into the Telegram mini app ecosystem, and unfortunately, a lot of those projects turned out to be scams. So once again, it's all about understanding from whom you are taking money, for what you are taking money, and what do I mean for what you are taking money. Think of that not as of, oh, I will take this money and I will dedicate 40% into the development, 30% into the marketing, and the rest on something else. No, what investors would like to see is, let's say, okay, you will raise a round of $1 million. Where this 1 million would bring you? To what kind of metrics? So think not in terms of the features. No one really cares about the features, for better or for worse. Neither users nor investors. Users are caring solving their own issues. Investors are caring earning money. And this is what you should really think of, and this is how you should approach it. As I already mentioned, key things, and this is why I keep repeating this, but because I would really want you guys to think from that perspective, that investors invest not into the product, not into the market, but into the team. Because the product would change. The market will get through different kind of stages, being hot, then not, then hot again. But if you will have the right team that attract great talent, that is passionate, that is able to infect early adopters, community, investors, business partners into basically working with you, this is the right way to do it. Then Dishant is also asking, I think this is a valid question. Do the VCs invest into the pre or post revenue businesses? Some, for instance, crypto projects are pre-revenue. But once again, and they get investment. It's all comes down, for instance, if you are a reputable developer with past experience, then you shouldn't have revenue on the get-go. I will give you a fair example about TonTon games, I think, because it's better to speak about my own self. So we raised quite fast. And even without the traction at the moment in terms of the revenue, primarily because I and my business partner know each other for 12 years. And what's more, my business partner previously founded the biggest VK.com gaming studio with over 65 million users in the CIS region. So it was basically a showcase that we are not just daydreaming, but primarily because we knew what we are doing, and this is why we keep doing games again. Then, how you should approach fundraising in general. Look at this as a funnel. Once again, I think comparing fundraising to sales and fundraising to job search is pretty much rational and relatable. First of all, create the ideal investor's profile. So who is your ideal investor? Why is this one? So what makes him ideal? Did he build before on this same protocol? Is he able or she able to open you some doors that are currently closed? So is he some sort of involved with a specific chain that you are building into? Does he or she bring any kind of additional expertise that is or network that is really much needed by your business? So think of it from all of that kind of standpoint and create ideal investment profile. Then define how much money you need and what it will help your business to achieve. I already told you to shift your expectations in terms of fundraising from thinking on how much money we need and how we will spend it on how much money we need and what it would allow us to achieve. Then create a long list of potential investors. Google it. Trust me, guys. I already mentioned Google is responsible for my career. Right now, also ChatGPT if you use it properly. But once again, create a long list of investors and then rank them. Rank is very much subjective. It could be who could make a warm intro to that kind of investor, whether this investor is active on social media, whether this investor is active in terms of the investment, and so on and so forth. And all of that will give you a definite list of investors. And start with reaching out to the investors that you are least interested in. Why? Guys, you are going to stink in your first pitches, especially if you haven't done it before enough. And this is absolutely fine. You will bump. This is also all good, but it will initiate the iterate and learn cycle. So by the time you would get into the most interested for you specifically investors on the list, you would be goddamn ready to shine. Then I think, and this is more of a sneak peek to our next week presentation, reach out in a way of the multi-stage. So here is an interesting insight. As a person who even found a vibe through cold emails, not just raised money or like closed multi-million deals, what you should understand that people most often do not reply to messages, not because they are uninterested, but because this message landed into the inbox into the wrong time. So having a sequence of deeply personalized messages, by deeply I mean it's not about change the name and the company name. This is bullshit. This will end up in spam. Don't expect to raise on that. It's more about quality other than quantity. So by having a sequence, you basically send over a few days or even a few weeks in a different time throughout the day, you basically increase the chance of essentially your email being opened in the inbox. Follow up, keep them updated. Once again, this is also important. Even if they rejected the investment at this moment, consider this is not no, but not yet. Red flags. What I think is important for you to understand, guys. Don't chase the prestigious VCs. Prestigious VCs most often invest into the experienced founders. It's not a good or bad, it's just the way the life it is right now. For you, you might end up being a prestigious founder that Sequoia and other funds would invest in. But if this is your first project or your last project wasn't successful, don't expect it. I still think that it is a good idea to apply to Andreessen Horowitz speedrun or to the Y Combinator, but not for the sake of getting in, but because the questions that do they ask are valid. It helps you to frame your way of thinking and highlight the areas of the business that are overlooked because we are so focused on the product, for instance. Don't ignore your financials. Once again, everyone understands that all of those 3-year, 5-year projections is bullshit. But it is more about the hygiene factor that you think about it. that you are essentially understand what you are doing in a way that you already think about financials, how long the company would survive, what would be the burn rate, and so on and so forth. Ignoring feedback is also a huge red flag. I won investors by just listening to them and then getting back to them and saying we actually used your feedback and this is the outcome. This is once again rare. It sounds so freaking simple, but you would be surprised how rare it is being done properly. Then always update investors. And finally, as I already mentioned, don't focus on the product. Product will change a lot. Think of the distribution channels. And as a cherry on the top, but I just wanted to check the questions first. I see Alec is talking to Dishant. So Art, thanks for the presentation. How things are going with games now? Is it possible to raise money for one Telegram game, or should the project be packaged as a studio and raise fund for several projects? Well, Art, it's a good question. So as you can see, right now, Ton, and based on my understanding, no insider knowledge actually, I'm just like a market player as everyone else. Ton right now changing the approach for the games itself. Is it possible to raise for one game? It's a good question. I believe it is still possible, but most likely you would raise not from Tom directly. You might get some support from them. This is no doubt, but you might raise from venture capital funds that invest into the gaming. Uh, Being a studio and raising funds might be better, but once again, it all narrows down not to your business model and how you're going to package the things that you would like to raise money for, but more about you. So for instance, if you would say that we are an experienced team of developers from mobile with, let's say, 10 years of experience and some sort of a successful project with, let's say, millions of users daily or monthly, this is another conversation. And this is more important than how you package the deal. And finally, guys, as a small cherry on the top of our today's presentation and a sneak peek for our next week presentation is essentially one of the best templates that I do use when I reach out to investors. I will walk you through it briefly, and it will give you the idea why it is structured the way it's structured, but we will dive much more deeper into each part of that next week. So, and this is only one email of 4. First of all, I start with some sort of a personalization, and not the lame personalization, but the real personalization. And by real, I mean that I really Google the person that I'm trying to reach out to. I really read his interview, and I'm referring to his interview in a meaningful way. Why it is working? Because trust me, all of us has egos, and we love being seen as experts. Even I am. This is why, in addition to everything, I love to share my knowledge publicly because it's a very pleasing feeling to be considered as an expert. We love talking about ourselves, and we love when someone else did their homework. And once again, very obvious to Google, but at the very same time, very few startups does it. Then we get into the offer part where we introduce ourselves and not get deep into the tech, into the features. This is all bullshit. In fact, we get into the traction of what is our number of downloads on chain, transactions, whatever. Then who is our team and how much money we raised so far in this bullet point way, because investors gets, if not even hundreds emails daily, and by having the email structured on that way, you will stand out once again, because most of the other emails would really stink and would be invest in our startup and let's get rich together and all of the other bullshit. Don't do it, please. Then you explain that you are currently raising money, how much money, why do you raise it, and why do you believe that this fund or person is the right choice? Explain it. And finally, a call to action. Don't have a multiple call to actions in your email. It shouldn't be provide feedback, test out our protocol, game, or whatsoever, and also let's have a call. Have one clear call to action. And it most likely should be let's have a call in a specific time, because no one, if you will say that we are happy to adjust to your calendar, this is BS. No one will go to their calendar, check when they are free, and so on and so forth. For that, just have in your signature a link to your Calendly, not more than that, but always start with a specific time and date. So guys, to summarize, fundraising is about trust, not just about capital. You guys, you, you are the product, and you are the one who going to raise money, not your technology, not even to some extent your traction, because it might come and go, but you and how stubborn you are as an entrepreneurs. Momentum beats perfection. Just keep doing it. Don't perfect slides. Don't perfect your pitch. Don't perfect your emails. Just keep going and improve on the go. And be relentless, guys, but stay human. As I mentioned so many times today during our presentation, business is run by people, so don't forget it. Guys, I think we're done for now. I'm happy to take a few more questions, and I believe we would wrap up for today.
Yeah, let's quickly cover a couple of questions. If there are anything that you guys want to ask, please don't hesitate to unmute yourself and go for it. Yeah, another question comes in the chat. Love your
Yeah, I
presentation.
see. From June, love the presentation, very practical and real. Thank you so much. I thank you for your time sharing. It's just thank you so much, John.
Yeah,
I really tried. I believe this is why Alec invited me again, because I don't like talking about building castles in the cloud. This is generic bullshit. Internet filled with it. I would like, and I wanted to bring you the real insights from my fundraising journey, and to give you the right mindset, because your fundraising journey most likely would be different from mine, but having the basics right into your head would basically shorten the investment cycle in a way that you would skip making the most obvious mistakes that are easily avoidable. It's much better to make unique one-of-a-kind mistakes in that sense than the ones that could be predicted from the get-go.
And yeah, I see Dushyant, you are unmuted, please.
Yeah, can I ask a question, Daniil?
Sure.
Please do.
Yeah, I just wanted to know, small projects, I'm just started. We have just started from last 3-4 months. We are getting traction, and my project's name is Fameverse. It is a social fi project, and what we are trying to do is connecting the influencers with the brands without eliminating the middleman. So my question to you is that like small projects, like we require funding and we are keep developing, we are trying to spend our funds, and uh, uh, slow and steady we will definitely going to get funding or traction, and the numbers are going to be great sooner or later, because we have already validated it and we really rely on having trust on our project. So like what kind of a support we can get from from the chain, or how to go about it, like initially, because at we keep developing, we will definitely get on reach the success stage. So can you just
Dishant,
elaborate something on that?
in respect of the others' time, I believe Alec already sent to you quite a few of replies and links where
Yeah.
you should start looking. And I believe you should start from that, at least in my experience. And I'm the person who raised money on Ton. So always study the guidelines and the public information first, because trust me, if we are talking about building trust, all of the executives on any chain, not just on Ton, hate when people out of nowhere come to them and ask stupid questions that might be googled easily. So ask meaningful questions, stand out, and to do that, study the guidelines. And this is the only way to go, honestly.
Yeah, I'll just add that probably next week we'll be having another session about the Builders Portal and all the opportunities available. So please stay tuned. Dushyant would be very happy to answer all your questions during the Builders Portal AMA session next week.
Okay, thank you. Thank you.
My
And
pleasure. Thank you, Alec. And we have a question from Bogdan. What are the timelines where it makes sense to get back to the investors? So it's a great question. I will try to answer it briefly. 2 weeks, it's short. If you're talking to the investors that said no to you, send them just quarterly updates. Don't make it weekly updates. Sometimes it makes sense to send them monthly updates, but quarterly is just fine. So yeah, this is how I would approach this and how I approached it before. Because making this too frequent is too much of a hassle.
okay, and Art, your camera is on. Would you
Yeah. Thank
ask?
you for this opportunity, Daniil. Thank you for your speech and presentation. Now let me ask you one kind of funny question. So, is it possible to get your email for training to pitch with the structure you have to show us? To maybe once you will respond for, oh, this is a good kind of project pitch. So now it's done. You can
You
go to
can
the.
just DM me on Telegram. I just sent to you my Telegram handle into the chat. It's not a big deal, guys. If
Nice.
anyone would like to reach out, just use it.
Thank you. But how to send email through the Telegram login?
But it's I mean, like, here is the deal. Just send me the email and Telegram. I could send to you whether this is a good email or not, because I just get used to that.
Yeah, of course. So thank you again.
My pleasure.
Thank you, Art, for asking your question. And is there anything else that we can quickly cover?
I think we're done for now. Just exactly within 60 minutes. Alec,
Yes.
we are stars. We did it great this time.
Yeah, thank you so much, Daniil, for such a great presentation. Very concise, very straightforward, and without any fluff, I would say, with no fillers. And yeah, very actionable. And yeah, for those of you who are watching this was just the first part. And next week on Wednesday, same time like today, we'll be having the second part of this fundraising series of workshops with Daniil. And next time we'll be covering the things about the investor outreach. And yeah, please make sure to follow us on social media and register for the next event. And yeah, Daniil, thank you so much once again for your time, for your willingness, and for your energy. Really like that. And yeah, staying tuned for the next one.
Thank you so much. Thank you for having me, guys. Good luck with your projects and keep building. Everything is